So welcome to my second video in the series, how to invest in stocks and shares. This is part two, the fundamentals of a great business. As we've looked at really in the first video, it's really looking at businesses you need to sort of, and you understand. Moat. Moat is really all about, does the business have a moat, a competitive advantage, or is it a brand leader? Has it got something sort of unique about it that sort of sets it apart from the competition? Because the last thing you want is tons of competition in and competing with the product and downgrading their position in the market. Does the business have expansion and growth potential? Is the business, are you seeing it very much in its early days, or is it very established or been around a few hundred years, but maybe there's a new management team in and they're taking the business in a whole new direction, which is maybe more exciting, or they may be taking it in the wrong direction, in which case you might want to avoid. So really you've got to look at the management of the business. It's really down to the integrity of the management. Have a look at their past performance. Either they've been the founder of the business that you're looking at, or they've come from other businesses that they've made extremely successful in the past. They're looking at their track record. There are professional CEOs out there who jump from one company to another, bump up the share price, take a nice big profit out of it for themselves, and really don't work in the shareholders' interest in the long term. So are they working in the shareholders' interest, the owners of the business? There are various business models out there, and really understanding how a business works is quite important. So Warren Buffett talks about his weighing machine model, in that he put in his early days, maybe in his teenage years, I think he got into the weighing scales business and started putting weighing machines into hairdressing salons and sort of places. And every time you put a machine in there, machine will be taking cash, and the owner of the site got a percentage of it, and he took a percentage of it. And the more weighing machines you put out there, the bigger the business actually was. The weighing machine model actually applies to very many businesses. You can think of that in terms of a retail unit, although they're fundamentally buying in a product, putting a profit margin on the top and selling it out at the other end. The number of retail units they have, then the larger the business, and they're all taking money. The same things applies to things like, say, pubs, for example, or restaurants, where they open a first restaurant and it's taking money, or if everything's going well, got the model sorted, and then you're rolled into the second, third, fourth, and so on. But each one becomes a cash-generating unit in its own right. There's also manufacturing businesses that are taking raw materials and assembling them, or changing them and altering them, and selling a product out into the marketplace, either through wholesalers or direct into retail to then resell. They will often sometimes benefit from not only the sales of the product, but also ongoing service of product, and maybe other ongoing revenues from a product. So nowadays in the tech age, we also have software add-ons into many products, which are also creating additional revenue streams. Business can also be a service sector model. That could be sort of financial services, for example, insurance, such as a car insurance, where they're bringing in money to cover the cost of the eventuality of a claim on a vehicle, and hope that the vehicle doesn't have a crash and they get to keep all the money. Doesn't often work out to be the reality in that case, and they're using the money in to reinvest in other markets to make money out of that money before they eventually end up paying the money out. So here I'm going to look at some basic key financial numbers that you'll see very, very regularly coming up. And there are a lot more than just the ones listed on here, and the more in depth you get into things, the more complicated it can become. But really want to try and keep it very simple and straightforward. It's very important for people to understand the difference between turnover, gross profit, and net profit. I've worked in many things in the past, and I've seen people talking about the turnover, and that means the money that's going into the till, and they assume it's 100% profit, and that's not the case. So turnover is the amount of money a business actually takes. Gross profit is the amount of margin they have on top of an item when they're selling it. And net profit is the amount of profit left over after all the other expenses are taken into account. So that may be the cost of the staff, employing people, cost of the rent and the rates, etc. Price to earnings ratio is the share price relative to the earnings ratio. EPS is earnings per share. So that may be partly dividend or partly the increase in the share value over a year, what that company is actually likely to do. Return on capital employed, the ROCE, is really a good measure of the ability of the management to utilise the capital properly, and it's a good measure of how good management actually are. But it should be really used in comparing other businesses of a similar type when comparing that number, because maybe, say, a supermarket retailer may be trading on quite a low return on capital, whereas other high-tech industries are returning quite a high return on their capital. So it can be quite different. Debt to equity is a very important one to consider. If the debt to equity ratio is below 0.5, that's pretty good. If it's over 2, then you need to be a little bit more concerned. All businesses generally will need to borrow money, and they will use that money to make more money out of. But there comes a point, if maybe either interest rates are too high or they're not getting the profit margins they need, then debt can become a major problem for a business. And it will leave a problem with the next one there, free cash flow. That's the trading cash in a business, part of which is operators' earnings. Free cash flow is a good way of comparing how a business is doing year on year, and the more free cash flow a business has, then the better financial position it's generally in to withstand those down days. Growth rate. Growth rate can be calculated on a number of ways. Sometimes in the past I've measured that on comparing the gross profit, so the net profit, my apologies, over a number of years and taking that as an average figure. Or you can look at the free cash flow over a number of years and compare that as a figure to see what the difference is there, to give you some sort of growth rate measure. So building a watch list. Watch list is really about building up a list of companies you know and understand. There's a whole variety of ways of doing this. This can be from businesses maybe you worked from in the past, businesses you're buying things from and using around the home or whatever, and you know and understand the businesses and how they work. Often a newspaper will have a city page in it with share prices, quite regularly as Daily Express or Daily Telegraph, or if you really want to go really in depth with loads and loads of shares, in Financial Times in the UK. I will work through the list and look at businesses that I kind of know or have heard of, and if the share price is looking low against the 52-week low, then I'll put a little asterisk by the side and put it on the list to come back and have a bit more of an in-depth look at a later point. There are also something called stock screeners available on the internet. A major one called Finviz, I think is Australian-based, looks at Australian shares and American shares and various other markets. Doesn't tend to cover the UK. Also Yahoo.com, Simply Wall Street, which is more subscription-based, and SharePad, which I do use SharePad quite a fair bit as well. So it will allow you to put in different criteria, such as the return on capital employed, or debt to equity ratio, or PE ratio, and you can then do searches, and you can search by sector and country and all sorts of things, which then gives you a much shorter list of companies to then have a look at. I tend to store my watch list on Microsoft Excel. I use the Office 365 version because there's a little data point on that which allows you to update stock prices instantaneously, so rather than have to go through and write down every single one as you things keep changing on a day-to-day basis. There's also a Google sort of Excel version as well. There's all sorts of things, but also ways of recording that information. So you really want to build up quite a fair list, not too extensive, but of companies. And if you're looking around, maybe build up to a point of about 75, if you go much over the 100 point, then it might be going a bit over the top. And they're not going to really want to be only 100 anyway. So, because when you're trying to knock it down to, in the first instances, probably 6 as a maximum number of companies that you're actually going to put money into. So finding a target buy price. This is really ideally half of the intrinsic value or the sticker price. I think in the first video we talked about the sticker price on a car that you may be looking to buy at a second-hand dealer or something. You don't really want to be paying that sticker price. But half is really a kind of great figure to be able to working towards. So Simply Wall Street, for example, does have a fair value on each of the stocks on its pages. I'm not quite sure how they do the calculations on that fair value, because it does tend to jump up and down quite a bit. But if you're not into the full calculators or ready for that yet, then it can be something that can give you certainly an indication of what would the intrinsic value price be roughly on the particular stock you're looking at. The DCF calculator is one I use quite regularly in one of the many other videos I do on individual stocks. And the template for that's available on my Patreon group, so have a look at the description down below. We'll also include some of the calculations on businesses I've looked at as well in more detail than as you see on the YouTube channel. Stock charts are available on Yahoo Finance. Quite simply, I'll often record the numbers for the 1 year high and low, 5 year high and low, and the maximum high and low. And I will try and use that if I'm not really getting say the intrinsic value I'm coming out with is way below what the stock price has been for many, many years, then the Yahoo Finance charts, etc., can be a very good way of pinpointing price points that might be more realistically achievable for a business. But the key thing really, as I said in the first video on this, is to be patient and wait for the stock to go below the MOS or target price. So happy hunting out there. Hope you find the great opportunities for you. If you're looking to invest, I put links below on the free trade and trading 212, which give you the opportunity to trade shares on a zero commission basis. You can either just add £1 in or whatever, and ideally they will actually give you a free share as well for just opening up an account. So I thought I'd take a quick look at the stock screeners that I use and give you a little look around. So this is simply Wall Street. So it does allow you to filter the markets you're looking at. So we'll click into here, and we've got the American markets there. The UK markets, let's do it on UK today. Click done. So you can filter by industry, and it gives you a whole range of things to look at there. So we'll take hospitality today, including casinos, hotels and resorts, leisure facilities and restaurants. Click done on that one. There are advanced filters as well, so let's have a look if there's anything here. So you can then select in by the market cap, which is the total value of a business, or the share price, the PE ratio. So look at PE ratio, and then it allows you to select what sort of level of ratio you want between, so 0 and we'll go 0 and 12. So we're a little bit under a 15 ratio, and press done. Okay, on this screener it's only found one business there, which is Heavy Tree Brewery on this occasion. I thought we were going to find a lot more, so I might change so it gives us a few more. Let's take that off the PE ratio. There we go, that's better. So in terms of hospitality in the UK, they're finding 45 businesses. So Compass Group, Intercontinental Hotels, Whitbread, major hotel and restaurant chain. William Hill's in gambling. Greg's, one of my favourite, for sausage rolls and a lot of takeaway business, but that's what they're best known for. Domino's Pizza. JD Wetherspoon's Pub Group. Mitchells and Butler Pub Group. Rank Organisation, which is Mecca Bingo and a lot of online gaming. Gym Group, Restaurant Group, Hollywood Bowl, which is 10-pin bowling. So there's quite a variety on there, but it then allows you to then click into the company. So let's drop down to something. Let's go have a look. It gives you this sort of snowflake thing in terms of what type of business they are and where the earnings are likely to be. Share price news. In terms of where the share's been tracking over the last few months or so. Market returns. Any other news and articles on JD Wetherspoon's that they've already written, and where they think the share price is to the fair value. They think at the moment the share price is overvalued. In the past, Wetherspoons is up on about £17 a share. So as the market changes, that fair value with Simply Wall Street does tend to go up and down a little bit like a yo-yo. So it compares the level of debt, the earnings per shares, and down here we're going to come on to return on equity and then return on capital employed. Now they relate to to past years, and then the financial health of the business, so debt to equity ratios, etc. So there's quite a lot of information in here to work through on a business and give an understanding. But obviously you do need to do quite a lot of homework really on these. So then let's go have a look at SharePad. SharePad I use in a slightly different way, although there's all sorts of ways of using it. That part there. So let's go to other lists. We'll go FTSE All Share. The alerts part there. I'm going to go to the full screen just on the shares themselves. One of the interesting things to do, because I've obviously set this one up with, you can see here, changes over the 10-year high, the 1-year low, the changes over the last week really, and the changes over a 4-week period, PE ratio, return on capital employed, debt to equity, and there are other ratios and things along there. So what's quite nice to do is to say check on the change over 4 weeks and then hit the sort button, and it will hit the whole of the UK stock market pretty much, and you'll see who the big risers are. Stobart Group up there at 57.9%, and then trading sort of downwards. Hit sort again, and it'll tell you who the biggest fallers are over a 4-week period. And the biggest faller at the present time has been Babcock International, the range of fallers. So this again probably quite key, can give you an indication of businesses that might be worth a look at in terms of maybe why they've fallen quite a fair bit, but it also may mean the company is on sale at the moment. So we look there, and particularly in the case of Babcock, they've got a pricing there with a 1-year low at 206.9 pence per share, and the current price is 206.9%, so pence per share. Apologies. So the company is pretty much on sale at the present time, with a high there at £12.96, so worth investigating further. So I'm going to move over to Yahoo Finance. Have a little scroll down. So here on Yahoo as well, you can also store a portfolio or watch list on here. It works quite well because there's a Yahoo app on the phone which allows you quite quickly to pull the information up on the screen rather than you have to go in through the PC. And it gives a nice way of building up shares on a watch list. You just tap into them and away you go. So let's find someone to have a look at there. So we'll go back into Greg's. I mentioned Greg's a little earlier, GRG. So go on to the chart screen, and it'll show you over the 1-year chart where things will be going up and down, and you can see the highs and the lows over the course of the year. Lowest points there at about 1150, currently up around the 1800 mark at the present time. That gives a 1-year high and low. So it'll tell you what the figures are. But if you do this actually on the app, it's quite useful because it does show on the screen the high figure and the low figure and the median point. Then you tend to record a 5-year figure, so it's doing exactly the same thing in terms of the graph of where the business has gone over a 5-year period. And a max, which will show you obviously the maximum time the share has been actually trading and how the business has actually grown. Greg's is a lovely example to do this on because you can see the business back in 1993 and how it's transformed and grown the number of retail units quite dramatically over a period of time. And really why value investing can be quite good, because if you actually bought shares in here at 43 pence a share, they'd be worth obviously substantially more than that figure nowadays. So a great return there. So then go over to Excel. So whereas Yahoo Finance is quite a nice way of actually keeping an eye on a relatively smaller list of things, Excel I use for a much larger list. So I'm holding the share price. If you're using the data tab here and hit refresh, so we've got the second column in there with price. The internet will then update all of those, every single one on the list. In a moment, look, there we go, and all the prices are changed to what they are at the present time. On this one, I tend to record the change in price over the 1 year period, so from the 1 year low. So we're seeing how much the pricing has moved, and you can pick out ones that maybe haven't moved an awful lot over the time, and that they're companies that the potential there to go up is a long way, whereas some of them obviously have jumped quite a fair way over the year. So recording in there the high and low for 1 year, 5 year, and the maximum high and low. I put in then we've got a target price I've got on the share at the current time. The target price will have come from the amalgamation of all the different fair value or intrinsic value calculating routes, the stock price over the time, and try and come up with a sensible target price to buy the share at. So if the price drops below that figure, then it's time to start buying into the share again. A bit further across on the spreadsheet, I'll go into on another video really some of the free cash flow calculators, etc., that are all sort of mapped into this one to give an intrinsic value. So other videos for another day. So happy hunting, and we'll catch up with you again soon. Don't forget to hit the like button, subscribe, and hit that notification bell for new videos. You can also get a free share if you sign up with Free Trade or Trading 212. Just need to deposit £1 and away you go. We'll see you soon.